Does your debt-to-income ratio affect mortgage approval? Imagine trying to fit a puzzle piece into a space that's just a little too tight. That's what your debt-to-income ratio can feel like when applying for a mortgage. This ratio shows how much of your gross monthly income goes toward paying debts like credit cards, car loans, student loans, and your potential mortgage. Lenders look at this to see if you can handle new monthly payments comfortably. There are two main types of debt-to-income ratios. The front-end ratio focuses only on housing costs, including the mortgage principal and interest, property taxes, homeowners insurance, mortgage insurance, and homeowners association fees. Typically, lenders prefer this to be no more than 28% of your gross income. The back-end ratio considers all your monthly debts combined. Most lenders want this to stay below 36% to 43%, but some may accept up to 50% if you have strong credit or savings. Your debt-to-income ratio directly impacts your chances of getting approved for a mortgage. A lower ratio suggests you manage your debts well and can handle new payments. This can help you qualify for better interest rates and more favorable loan terms. On the other hand, if your ratio is high, lenders might see you as a higher risk. This could lead to a mortgage denial or higher interest rates to compensate for the risk. Different types of loans have different limits. Conventional loans often prefer a debt-to-income ratio below 36%, but some lenders allow up to 45% if you have other strengths like a high credit score or cash reserves. Federal Housing Administration loans usually accept ratios up to 43%, sometimes higher with additional factors. USDA and Veterans Affairs loans typically set limits around 41%, but these can vary depending on the lender. To figure out your ratio, add up all your monthly debt payments and divide that total by your gross monthly income. Multiply the result by 100 to get a percentage. When interest rates rise, your monthly mortgage payments can increase, which might push your debt-to-income ratio higher and reduce the amount you can borrow. Knowing your ratio before applying helps you plan better and improve your financial profile if needed. It's important to remember that debt-to-income ratio doesn't include everyday expenses like food, utilities, or health insurance. It's based on gross income, not your take-home pay. So, while a low ratio is good, you should also consider your overall budget to make sure you can comfortably afford your new home. For buyers, keeping your debt-to-income ratio below the recommended levels can boost your chances of approval and help you get better mortgage terms. Sellers benefit too, as they can better understand what kind of financing buyers are likely to qualify for in today's market. Economic factors like rising interest rates can influence your debt-to-income ratio and affect housing affordability and market trends. Staying aware of your financial health is a smart step on your homeownership journey.